Here's what you need to know about home equity lines of credit. HELOCs are great in that they give you access to equity in a property as you need the money. But there's key points to HELOCs that you need to keep in mind. So let's start with the interest rate. The rate is typically based on prime plus a margin. Prime right now is 8%. It just went down a half a point with that Fed rate cut from a couple weeks ago. The margin that I've seen could range from 0% to 5%. So prime plus 1, prime plus 2, prime plus 5%. But you might have a margin that's a negative number, meaning your rate would be prime minus 1% or prime minus 0.5%. Credit scores and overall equity in the property can play a big factor in determining the margin. The next thing to know is how often can the rate adjust? Most HELOCs are adjustable. They can adjust monthly, they can adjust quarterly. There are some fixed rate HELOC options out there in the marketplace, however. The next thing to know is what is the floor rate and what is the ceiling rate? The floor rate implies how low can that rate go. The ceiling rate is how high could the rate go. So looking at the line of credit agreement, I was looking at one recently, and it showed the rate would be prime plus 1%. And that's about average, I'd say, for most that I see. However, in the fine print, the ceiling, it could go up to 18%. Now, hopefully we never see HELOCs at 18% because that'll likely mean fixed rate mortgages are not too far behind. And it's been a really long time since we've had mortgage rates in the teens, not since the 1980s. The next thing to know, the draw period versus the repayment period. The draw period is when you can access the money. This could be 5, 10, 15 years. You can borrow against the line of credit, pay it back, borrow again, pay it back. You can borrow as much as you want up to the limit. Now, during that draw period, most HELOCs are set up that the payments are interest only. That's the minimum payment. You can, of course, pay additional money towards principal. You do not want to rely on solely interest-only payments. That's good from flexibility in your monthly budgeting standpoint, but long-term, you want to figure out what will it take to pay the HELOC off during the draw period. Take your balance, take the rate, take the length of the draw term, enter all that information to an amortization schedule. There's plenty of those online, and figure out what you need to pay each month. Do not wait until the draw period's over and repayment begins. I've seen plans where the repayment phase is based on a 10-year principal and interest repayment. And if that happens, you're going to see a considerable increase when you go from interest only to a 10-year principal and interest loan. And keep in mind, if the rate is adjustable, like most HELOCs, anytime that rate increases, you're going to see additional increases in the payment. Now, I've had some people say, well, once the draw period's over, if I need to, I'll refinance into a new HELOC. That could be an option, but it may not be an option. What if your income changes? What if your credit changes? What if the value of the property changes? A new HELOC may not be in your future, so do not rely on that. The last thing I want to leave you with is the balance to limit ratio. Much like credit cards, the balance to limit ratio in HELOCs can influence your score. So you do not want to max out your line of credit. If you think you need $50,000, but you can qualify for more, if it were me, I would apply for more. If it's $100,000, $150,000, whatever that number is, that can help with your balance to limit ratio, which can help with your credit scores. And if you need additional money in the future, you can tap into that remaining line of credit. You do not need to worry about applying for a new loan. So take all this in consideration if you have a line of credit or if you're thinking about opening a HELOC. And if you have any questions, just click on my link tree.